The kind of person that doesn't value their reputation or their brand enough to have somebody running around who doesn't know the deal, I don't want to invest with them. The kind of person that doesn't put in the effort and the time to invest in a person so they know the deal. Now I have to question, did they do due diligence well? Did they do comps well? All these issues, like, are they just trusting a financial broker, or do they actually understand the debt market? Are they getting hoodwinked? Did they just go to a broker and whatever's the lowest offer, take it? Did they even call up a local bank, or did they call a family office? Do they know how to get capital? If they're so willy-nilly to just hire some kid off the street to raise capital for them and compound it by not explaining the deal well to them, will they close? This is a real risk to investor.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today we have back our guest, Andrew Rosenberg, and we're going to dive even more into real estate syndication, right? And what do you need to know before that? Or maybe the questions that you need to ask, or the things that stick out to Andrew that you should ask an operator that you need to know in that vetting process that I hope you're going through before you invest your hard-earned dollars. He elaborates a lot on boots on the ground, how important that is to him. But we talk about what that means a little bit, which I think could be some confusion around that in the industry sometimes, the vertically integrated versus not, and who considers that boots on the ground or not and whatnot. But I know you're going to learn a lot from him today. Andrew, welcome back to the show. Honored to have you back and appreciate your time and allowing us to do a series or a small series of shows here, diving into your experience investing in syndication, especially passively. I'm wanting to have more passive investors on the show, and it's great to hear just different opinions of how they got started in investing passively in syndication and the questions they like to ask and vetting deals and operators and all that, which we're going to jump into that today with you. And let's dive right in. And I know there's things that you like to consider before investing in a syndication. Maybe let's talk about some of those. Then we'll dive into even some of the questions you like to ask operators and how you vet them. But what do you like to consider beforehand?
I think the first thing that people need to understand is that it's a moving target, your education and your knowledge level. It never ends. It's not like you're going to have on stone tablets the 10 commandments of vetting a deal. You're not going to ask a syndicator every single one of these questions. I've seen it. Bronson Hill, who's a good friend of mine, I just adore him. I'm a little biased. I really like him personally. He has it on his website, I believe, I forget what it is, like the 18 questions you should ask. Lane Kaoka, who's a personal friend of mine, I think he had 25. Benjamin Yeager, who's a friend of mine, I think he had 99. And of course, I always tease him like, Benjamin, no one's asking 99. But he wanted to be exhaustive. He wanted to cover everything, and he meant well. And it's good. You have to understand that it's a moving target. A lot of the stuff will be covered in the presentation. One of the funniest things to me in the world is my wife would spend 2 hours researching a washer dryer, which good. I don't want to buy a lemon, right? But if I ask her to watch a 45-minute webinar video, she's not going to make it through. Granted, it's just boring as all hell to her. But the washer dryer set was maybe $5,000 at the most. And we're talking about investing $50,000, and she doesn't want to watch the video. Fortunately, my wife never watches any social media, and I'm just being tongue-in-cheek. I love her. But the joke is that most people will spend more time researching a toaster oven than their investments.
Yeah.
It's just crazy. I mean, you're going to some people will research the heck out of buying a new truck. Truck costs about the same as a syndication investment. You're going to go in for test drives and you're reading. I don't know what truck guys read, not Car and Driver, but whatever publication truck guys read. I'm not a truck guy. Get the analogy. It's like, man, what are you doing? You're going to spend countless weekends reading about, is the iWatch good or a Samsung watch good, or whatever bling the kids wear these days on a wrist. And you'll see I'm not into that stuff. But when I ask somebody to spend time on investments, they won't do it. I've never understood it. You want to be in control of your financial future. You don't want to be a victim. And it's a substantial amount of money. And the consequences are pretty significant about, can you pay your bills? Can you retire? Can you send Johnny off to college? Can Jill go to graduate school? Can you afford your divorce? These things are kind of serious. So I would say that's part of the issue is the allure of mailbox money or passive. Get over it. It's not. There is no such thing as passive in life. I mean, there is passive. If you want to be truly passive, stay on the sidelines and be a victim. That's my unkind advice to you. So, you're going to have to get over yourself and do the work. The main things for me is I really hammer on two issues. I don't know underwriting. I'm not going to open up the spreadsheet and check everything down to a fine-tooth comb. If you're being honest with yourself, even if you're from a financial background, and I have a master's in accounting, I did work in corporate finance. Even if you're quantitatively oriented, you're not really going to do a good job of proofreading the financing. All your goal is looking at the underwriting is to look at the major assumptions and say, are these in line with the industry? Are these reasonable? So if you're looking at a market and they've got 10% rent growth a year for the next 5 years, run for the hills. It's baloney. That's obvious, but a lot of people don't even do that kind of stuff. The other thing is, if you're looking at the underwriting, you're like, it just looks like numbers. Ask. A lot of people are afraid to look stupid or ignorant. Again, that's your ego or pride getting in your way. And frankly, that's what their job is. Their job is to service the investor. If they already answered it in the webinar, ask again. And if they're annoyed to answer you, give you a lackey, or it takes 3 days to get you an answer back, don't invest with them. I mean, in all seriousness, do not invest with someone who would do that, because you'll meet, and you said Joe Fairless is a friend of yours. You can ask Joe Fairless. I know enough about the man. You can ask him a stupid question as an LP investor. He's going to answer it. He's not going to ridicule you. He would not mock you. He's going to help you. Which you do not want your money with people who don't appreciate you or your money. If you're just a target, if all you are is a dollar sign, a stepping stone to their dreams, that's probably not the business partner you want.
That may even be a good little step, right? Is to ask somebody a kind of basic question and see what kind of response you get.
I'm not real big on being somebody's stepping stone.
What asset class are you focused on? Or are you in numerous asset classes?
I'm across the axis, the stream of assets. But to be honest, multifamily usually would be all things being equal, multifamily would be my favorite because it's the simplest. I view it as the stupid-proof asset class. Right now, I'm not as big a fan of it. I don't like the valuations I see. The deals are kind of skinny, to be fair. But I like industrial. I like storage. I don't actually have any storage. If anybody's watching that's a good syndicator of storage, hit me up, because I haven't liked anything I've found. I'm not against mobile homes. I just haven't liked the deals I've seen, or in some instances, but certainly not all. I haven't liked the operator, or it just wasn't a good fit for me. That's another thing, is you don't have to be afraid of telling an operator, I like your deal, I like you, but no. And there's nothing wrong with it. It's not a rejection. It just has to work for you.
Yeah. Every investor definitely is in a different spot.
Yeah, it can be as simple as personality fit. Some investors, there's guys that they really don't want to hear from the syndicator. Send me my distribution. And frankly, a lot of them just send me in 5 years, let me know to look at my bank wire, but I just want to see my 2x return in 3 to 4 years, and just don't bother me. Other people, we kind of want to know, hey, is the deal going well? Is it occupied? Those are two different priorities. Those are two different syndicators. There's syndicators out there. They've got 400, 500, 600 investors that are patient. They might have family office money. They might have insurance money. They don't want to hold your hand. That's great. They've got their investor base. Maybe you're not the investor for them, and vice versa. Fit is really important. Like, we were joking later. It's like, having a bad girlfriend or boyfriend that you're going to have to evict from your apartment, possibly. You're in this for a long time. Your money's tied up, and you're in a relationship. Better be aligned, not just financially, but in terms of values and expectations. So if you're expecting monthly reports and they're expecting to only call you when there's a problem, it's not going to work. So one of the things I look at is going to be, the first thing is, if you have the network for it, that's why the network is so important. Ask your friends, has anybody invested with these guys? What's their reputation? Recently I was in a breakout room, and there was a person talking to somebody, and they forgot I was in the breakout room. It was kind of funny. They were bad-mouthing somebody pretty bad for being an absolute fraudster, just a piece of garbage. And then to their embarrassment, they're like, oh crap, Andy's in the room. We didn't know that he was in the room. And I don't repeat the name, and I haven't really told anybody about it. But unfortunately, yes, there are bad people in this space.
I thought that was good advice, though, is go back to the network and ask people who have invested with this guy before or this group. No doubt about it.
Yeah, it's not even just about like, have they exited? Are they honest? Like, what kind of returns you'll make? It goes way beyond that. It's almost like when you ask a seasoned investor, someone who's been doing it for a long time, like some of my mentors that I call up and ask for advice, they'll say to me, that's not the guy for you. And I know what they mean by it. They're not saying the guy's not good. They're not saying the lady doesn't perform financially. They know me well enough personally that they're like, this isn't going to be a good fit. Andy's not going to like them, or they're not going to like it. They can tell, like, this is not a good relationship. This won't be a good fit. So when someone says to me, hey, Andy, give me 5 tips. I want to invest in storage and multifamily, and we'll just put an RV park in there. So give me 5 tips. I can't answer your question. I don't know you. Like, I'm going to have to meet with you, and people don't understand why I have to ask, like, well, how old are you, and how close to retirement, and what is your day job, and what's your background, and what's your educational background, what's the level of time you're willing to put into this. And while we're doing that, I'm trying to gauge your personality. And of course, I'm no psychologist. When we're doing this over email, it's a very tough question. Somebody says, what operator should I invest with? So like when I'm saying your network, it's not just, hey, I met Tim at a conference in Miami. I got his business card. Now I'm going to ask him who I should invest with in multifamily. What I'm suggesting goes way levels beyond that. The person you're asking has to know your situation, but further, they really have to understand you, your values, and your psyche. For me, which was very embarrassing, I had lunch with 2 local Hawaii investors comparing notes, and she wanted to know what deals I'm in. And I was telling her one of the deals that I liked that was performing well. And I could tell by her facial reaction, there was a problem. So we had to step back, and I had to say, I know something's wrong. What's wrong? And the husband was kind of giving me the look like, don't ask. And I was like, look, I got to ask. I can read faces. I'm no genius, but I'm not that obtuse. And she finally said, we were doing due diligence on properties we're looking to buy. She was acting as like an agent for somebody to do some consulting work, to do due diligence. And the deal that I'm in was run by somebody who was running these properties. And she said, it was embarrassing how slumlord the operation was. She said she almost was in tears after interviewing so many people unhappy with where they lived. The owner was jacking up their rent, but not providing value add, which we'll get into later, pet peeves and falsehoods of words. But someone saying, I've had this problem and it's been 3 weeks, they never fix things here. And that I was associated with somebody who would do that. I have to tell you, I'm not kidding. It ruined my whole morning until we just kind of figured we'll just get over this. But it really hit me hard. I mean, it was just a terrible feeling. Now, granted, in my defense, the building I'm invested in with that person is a Class A building. So I'm pretty sure those tenants aren't complaining. They keep the building immaculate and there's an incentive to do it. But yeah, for me, my value system, I'm not interested in anybody that wants to play some slumlord. If Whitney calls me up tomorrow and is like, Andy, we got this D-class deal in Memphis. We're going to just eviscerate these guys. We're going to jack the rents up on them. They've got nowhere to go. We're just not fixing nothing. We're going to just jack rents up. We're going to make 40% IRRs. And the numbers work out, Andy. Don't worry. Don't call me. Don't ever call me again. I don't want to do it. I don't like money that much.
Of course not. Definitely don't want to be doing that. We don't want to have to wear a vest anywhere that we're going to collect rent.
There are people that don't care.
Right. Or no doubt.
And that's for them. So in all seriousness, when you're saying, asking your network where they would steer you, not that I want people like that in my network. I'm just saying how we would steer people to which syndicators. I know enough syndicators now. I'm not going to send certain people to certain people just based on literally value proposition, what their values are. I can't send somebody who's ruthless, let's just say, and not in a pejorative term, just is. I can't send them to my friend Jonathan Tonks. He's a very devout Christian. He wants to do good deals. And what good deal to me means a benefit to the community, a benefit to the resident, and a benefit to investors. I can't send somebody that only cares about money to Jonathan. It's not going to work between them. I wouldn't want to do that to my friend. He wouldn't enjoy having that person as an investor. I don't want to do that. So when you say passive investor, I always find it funny. People say Andy's a passive investor. There's a lot of work that goes beyond the scenes. I'm just happy I'm not dealing with the lender and I'm not dealing with property manager. There's less work, icky work. But to say that passive, there's no passive.
Speak to, you found the operator though, and some of the questions you may ask, dig in a little bit with a specific operator.
Okay. I mean, like the very first thing I'm asking is about the debt. And I'm a real hard ass about the debt. To be honest, I've seen presentations, and this isn't to knock people. This is not me trying to boost myself up. I'm not a syndicator. So far be it from me to knock syndicators. But I'll be honest with you, I get pissed off when I watch a presentation. I'm going to spend 45 minutes of my time and we don't cover the debt. I'm pissed now. It's disrespectful, it's dishonest, and it's dangerous. This is a highly levered asset class. Its returns are highly correlated with leverage. The debt is a big deal. There is no real estate, there is no debt. Debt is real estate is debt. They're kissing cousins. Let's just not pretend they're not. So for you to not cover debt, I mean, it's just a cardinal sin. You're on my poop list now permanently. If it's a younger operator, I'll have some forgiveness and I'll say, what about the debt? We'll have a conversation, email me. The odds of me investing is slim to none. I may advise them, hey, you're a younger guy. What you did was a bit egregious. I would advise you never to do that again. Maybe I'll take the time. Probably not. The time I would be is if you are affiliated with someone in my network that I know, like, trust, and respect, then as a courtesy, we'll have that hard conversation where I'm going to call you out on your baloney. Try not to swear here. I have a potty mouth. And I'm going to try not to drop a couple F-bombs and yell at you. I'll be honest. I'm not that nice a guy. I'm trying really hard to be a nice guy. Nice guys go further in real estate. But to not discuss debt, I mean, it's irresponsible. It's dangerous to your investors. It's just not acceptable. It's not cool. You deserve to get yelled at a little bit for it, Frank.
That'd be a good title for a show. Nice guys go further in real estate.
Yeah, but I mean, it's totally true. The most successful people I know are the most generous, ego and controlled, giving, nice people. I mean, there's some douchebags, yes, that make the headlines, and I'm not going to name names that I just can't stand them. But by and large, there's way more successfully nice people than douchebags out there. Usually it catches up to them. Maybe, there's one guy in particular I'm not a fan of, and that's fine. He's done real well for himself financially. It'll catch up to him somehow. We all know that it will eventually. And unfortunately, it'll probably hit him in ways that are within his family or his health. And that's sad. That's called karma. And I don't wish that upon him, of course. I don't wish that upon anybody. But to get back to being more specific, this is a kind of a related thing. Who are you talking to? Are you talking to a capital raiser on their team? Are you talking to a capital raiser they hired 1 month before close who doesn't know the deal? Not to say all capital raisers that are new don't know the deal. I'm mad, frankly. I don't really enjoy talking with Pete, who's a roofer, and on the side, his side hustle is capital raising. And Tina called him up and said, hey, we're short money. Go get us money and we'll give you 20 grand if you hit this quota of money. We're on a call now and I ask you, hey, is the debt agency or bridge? What's the length? Is it 5 years? Is it 10 years? Is it fixed? Did you buy a rate cap? And the guy's like, I got to get back to you. We got a real problem here. You don't even know the deal. Don't talk to me. It's time to hit click. If you're the investor, it's time to go. It says a couple bad problems. One, it shows that they don't care about you as a person. They view you as a number. They view you as capital and capital only. That's not a relationship I want. Maybe that's fine for you. My advice would be, no, there's other and better people out there. The kind of person that doesn't value their reputation or their brand enough to have somebody running around who doesn't know the deal, I don't want to invest with them.
Sure.
The kind of person that doesn't put in the effort and the time to invest in a person so they know the deal. Now I have to question, did they do due diligence well? Did they do comps well? All these issues, like, are they just trusting a financial broker, or do they actually understand the debt market? Are they getting hoodwinked? Did they just go to a broker and whatever's the lowest offer, take it? Did they even call up a local bank, or did they call a family office? Do they know how to get capital? If they're so willy-nilly to just hire some kid off the street to raise capital for them and compound it by not explaining the deal well to them, will they close? This is a real risk to an investor. It sounds silly because what's the worst that could happen, Andy? You get your money back. No, this is a risk. If I give you $50,000, Whitney, and we have problems, and let's just say interest rates spike, that interest rates aren't always nice and smooth and predictable, or God forbid, credit markets should ever freeze, never happened. GFC just never happened. And 9 months later, Whitney calls me up and says, Andy, we kept doing the retrades, but rates came up and the seller finally said, the heck with it. I'm not going to sell it for that price. We're going to give you your money back. Am I getting it tomorrow? No. It takes weeks to get the money back. So now we're 9 months, 10 months into the deal, and I've lost all the opportunity cost of the money. I've had lots of aggravation. And there's several deals during that 9 month span that let's just say I didn't invest with. That was my 50 grand of capital that I had to invest for the year. And I missed countless deals during that 9 month time. The compounded loss of the deal not closing for an extended amount of time is really bad. And it happens. I'm not saying it's entirely a syndicator's fault or they should be knocked for it. But as the LP investor, can they close is a legitimate issue. If this is somebody's first time capital raise, let their friends and family finance their education. Why should you as the investor finance somebody else's education? You're taking on additional risk factors you're not being compensated for. If two deals offer 15% IRR, let's just say, they're both in Dallas, they're both B-class deals, let's just say everything's fairly comparable. And one guy's done it never, and the one lady's done it 10 times. I'm sorry, the deals are not the same. You're not being compensated for that element of risk. If one deal has a fixed debt of, let's just say 6.5, and another deal's variable, and all the other numbers are the same, everything's the same property manager, same city, same asset class. Again, you're not being compensated for taking on additional risk. There's levels of risk here. So what I see young investors often do is they don't even comprehend downside risk. Whatever's the highest IRR, that must be the best investment. And undoubtedly, they come from two places. They come from equities and they come from Bitcoin or cryptos. They're fleeing one asset class to go to another, but they're bringing the same flawed mentality with them of chasing returns without really understanding downside risk. It's like a bond investor who says, whatever bond has the highest yield, I'll buy. And you're like, no, you should be looking at a risk-adjusted basis. If one bond yields 7% and another bond yields 6%, what's the better investment? Duh, it's a trick question, because the 7% bond is a junk bond and the 6% bond was a AAA rated bond. The AAA rated bond at 6% is crushing that 7% junk bond. You had no context. It's no different in real estate. It's just you can't go into the newspaper and pull up, bond rate. You don't get to pull up syndication ratings. There is no Morningstar for syndicators. You know what I mean? So yeah, the onus is on you to figure these things out.
That's a good idea, though. Maybe there could be something like that.
Actually, there's a gentleman I was talking with who wanted to start a forum to kind of help these issues. It's just tough because a lot of people don't want to say something bad. One, because you're admitting now that you were an idiot because you were invested in that deal. So their pride gets in the way. Will they share the info? I have my opinion the deal's going bad. And now you're mad at me, the syndicator, for airing your dirty laundry and accusing me of being a jerk or trying to be vindictive. Maybe it was true. Maybe it wasn't. Maybe I was just being honest about the deal. Maybe my impression is wrong. Maybe the deal's going just as it's supposed to go. And I don't understand the deal. If it's a heavy value add deal, I'm not supposed to be getting distributions. So somebody writing, let's just say Pete writes in that Whitney sucks. I'm not getting my distributions. And then Whitney has to chime into the forum. No, man, you remember the PPM. We told you the deal. This was a heavy value add deal. I told you no distributions. Why are you posting no distributions as a complaint? So it's a tough thing. It's fraught with how will we keep this reasonably objective? Because I'm not going to ever imply that Morningstar is objective. And definitely I'm not implying that any rating system is gospel truth. But at least there's some systemic attempt towards objectivity. I'm not going to say there's a success towards objectivity.
Even goes back to the network too, and being connected and to other investors and learning from a group, a collaborative kind of piece, learning from lots of investors potentially who have invested with someone before that have just taken one opinion.
Can I do a quick rant?
We're almost out of time for this segment, but I wanted you to get to speak to, we're talking about like questions that you like to ask GPs, but I wanted you to focus on like the property management or asset management or boots on the ground piece that you're asking about.
That's where I'm going with it. And it's in several fashions why boots on the ground is a big deal to me, not to everybody. And I'll give you the quick story because I know we're running on time, but to me, boots on the ground means everything, particularly like in a tertiary market. I like tertiary markets. Some people don't like them. I'll tell you my reason for liking them. If I'm investing with Eric Charlton in Buffalo, New York, and his partner, they own buildings. I trust their rent comps much more than CoStar. And I definitely trust them much more than a broker's. And this isn't to insult brokers. The top 5% are great guys. The other 95% are useless salesmen that suck. Let's just call them what they are. They're bad people and they suck. No, the top 5% are good guys, and those are who you want to work with, and they exist. If you tell me a rent comp and you're a remote investor, you're using data from CoStar, or you're going on the internet, or you're trusting your broker. I trust Eric's numbers a little better. When he says we own the building across the street and we get $850 a month, the deal you're looking at, Andy, they're saying they're going to raise rent to $1,000. Ain't happening. Our building's nicer. No, I don't need to get into advanced data of what the median household income is. I don't care. I can call Eric and he's telling me, no, man, this is no way. When I say the building I'm looking at in Buffalo, just say, they're saying it's going to cost them $5,000 to bring it to A class. And I'm being ridiculous, $5,000. And he's going to tell me, no. We just upgraded a building 3 blocks away and it was $15,000 to go from B to A. If they're telling you X, they're full of it. The whole underwriting is all projections. So garbage in, garbage out. Who has the best data? The boots on the ground. Now, I'm not trying to bash CoStar. It's a great starting point. Data analytics are wonderful for directing you to a market or a sub-market or a city, that kind of thing. To raise an issue of like, maybe we should even look at a place, or maybe we should look at this place. But you got to get to the micro. That was macro data. The micro is the boots on the ground. They're going to tell you, no, that's on the edge of this neighborhood. And on the edge of that neighborhood is the bad neighborhood. It's an interesting thing. Everyone has perceptions based on where they live. Some places it's more segmented of where the nice neighborhood is and where the bad part of town is. And in some places it's all over the map and you can drive from a good place through the bad place into the good place really quickly. And if you don't have a boots on the ground to tell you, no, you might be in that zip code, but you ain't in that neighborhood, sweetheart, you're in deep trouble now. That's the dangers of being a remote investor without boots on the ground. I can play that game and lose money doing single family houses. I don't want to do that buying apartments with another remote investor. There better be a team member with boots on the ground.
Does that include if they're vertically integrated? They have their own management company. Do you consider that boots on the ground?
Oh, yeah. Yeah, that's a huge aspect of it. One of the things is, to be honest, I almost never hear property management done well in the presentation by syndicators. It's a huge pet peeve of mine that it is what it is. It's always going to be. I always end up having to ask more questions after every single presentation or webinar, almost every single one. And I get these great responses sometimes, and I end up investing in the deal, but I can't tell you how many times I end up asking, why isn't that in the presentation? What you told me is powerful. When you tell me, hey, The comparable building that's a block away is run by the management team we're hiring. It's run well. The building we're buying is run terribly by a mom and pop. The building, that we're comparing it to, it's professionally managed by a really good company. That's who we're going to use to buy the building run by Tina and Johnny. That's a great story. But why didn't you tell me that in the presentation? Why did you just tell me ABC Property Management, they're responsible for 6,000 units in this submarket? They're BBB, Better Business Approved. Like, why did you copy and paste some cheesy infographics off their website? If you're going to tell me we've been dealing with them for 10 years, they manage 9 buildings in that city with us. I kind of want to know that. Why didn't you tell me that in the presentation? It's an important thing. As the LP, again, we talked about earlier, but it's your job to ask questions. It's not pushy. You don't need to apologize. I'm not saying ask it in an obnoxious fashion. I'm not saying ask 99 questions, but ask the questions. And if they don't give you good answers, if it takes them too long to give you an answer, or if they have an attitude about giving you an answer, that's a great tell. It's not the deal for you.
No, great information. I appreciate you elaborating, vertically integrated or property management, having boots on the ground. I agree. It's so important. I've seen it firsthand as well. And the value of that versus not, numerous assets that we have and now manage in-house also. Andrew, tell the listeners again how they can get in touch with you. And then we're going to do another segment on some more case study type things and talking about more deal specific things. But for today, how can they get in touch with you and learn more about you?
The best thing to do is go on to LinkedIn, hit connect, pretty easy guy to find. I post very, very frequently on LinkedIn, probably a little too much, and very easy to find. Just connect with me on LinkedIn. That'd be the best way.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.